Let's take a look at exercise 9-1, dealing with lower of cost or market. Herman Company has 3 products in its ending inventory. Specific per unit data for each of the products appear in the table you now see on the screen. On this problem, we are asked to determine what unit values Herman should use for each of its products when applying the lower of cost or market rule to ending inventory. Ideally, market would be measured as replacement cost of the inventory item. However, the inventory's current replacement cost must fall between the net realizable value, which is the estimated selling price in the ordinary course of business, less reasonably predictable costs of completion and disposal, and the net realizable value reduced by normal profit margin. Net realizable value is referred to as the ceiling for market, and net realizable value reduced by normal profit margin is referred to as the floor for market. Market value is always the middle amount of the 3 values: replacement cost, net realizable value, and net realizable value reduced by normal profit margin. If replacement cost is greater than the ceiling, then market becomes ceiling. If replacement cost is less than the floor, then floor becomes market value. As long as replacement cost falls between the ceiling and the floor, it will be considered market value. Press the Continue button when you are ready to proceed. On the next slide, we will return to exercise 9-1. Now let's take a look at the solution to this problem. First, let's define NRV. NRV stands for net realizable value, and we define net realizable value as selling price less disposal costs. NRV represents the ceiling when we are applying lower of cost or market. NRV minus NP is defined as net realizable value less a normal profit margin. NRV minus NP represents the floor when we are applying lower of cost or market. Since in this problem we are applying lower of cost or market on a product-by-product basis, let's focus now on product 1. Replacement cost is $28 and NRV is $36. NRV of $36 resulted from subtracting $14 of disposal costs from product 1's $50 selling price. NVP minus NP is calculated by subtracting a $6 normal profit from the $36 NRV we previously calculated. Since the floor value to use is $30, and replacement cost falls below the floor value, the designated market value to use comes from the NRV minus NP floor value. The $30 NRV minus NP floor value becomes the cost and per unit inventory value that Herman must use to value this product's inventory. Moving to product 2, we calculate net realizable value of $78 by subtracting $50 of disposal costs from product 2's $128 selling price. Net realizable value less a normal profit margin comes out to be $53, which becomes the floor value. Since the ceiling value of $78 is lower than the $93 replacement cost, the $78 net realizable value is used as the designated market value. Since $78 is less than product 2's cost of $98, Herman must use the $78 as its per unit inventory value. For product 3, replacement cost exceeds the product's net realizable value. Therefore, Herman will use net realizable value of $32 as its designated market value. Here too, the designated market value is lower than cost, so the company will use the $32 designated market value as its per unit inventory value.